Hi everyone, I'm Miranda Brownlee, editor of SMSF Adviser. Today I'm joined by Corey Bannister, Chief Lending Officer at Trobe Financial. We're going to be discussing Trobe Financial's recent win in the SMSF Awards and also discussing Corey's predictions for the property market and what that means for SMSF investors. Thanks for joining us, Corey.
Thanks, Miranda. Delighted.
So Trobe recently took out the SMSF Loan Provider category in the recent SMSF Awards. What does it take to make a successful loan product in this market, particularly when you're targeting SMSF investors?
Yeah, thanks, Miranda. And first of all, we're delighted to have been awarded the SMSF Loan Award. So thank you to everyone who voted for us there. In terms of what we think makes us a compelling offer in that space, there's probably four key things that we think drive that award for us. The first being we've had the benefit of time. The product has been in the market now for a decade. So we launched the product back in 2012 and we've been able to continue servicing those customer base during that time. And we think that over that period, we've built up a great reservoir of trust amongst our referral partners, but also our customers who are seeing that we're committed to this space. And over that time, we've also been able to further innovate the product and refine it as we've gone along. The second thing is we think we make it easy to use and easy to access. We have our credit staff available for our borrowers, their advisors, their accountants, brokers, whoever is involved in the transaction can speak to our credit team directly, which we think is useful in terms of structuring the deal. And we keep the forms and documents relatively simple for those guys to use. The third component would be that the product has a number of flexible features, and this is something that sets us apart from others. Lenders will differ in terms of requirements around liquidity levels in the fund size, how they service the transaction, whether they'll lend to regional locations, for instance, commercial transactions. So these are some of the things that we think about, and we think our settings are very, very favourable in those areas. And then the final component is our referral partners. Over that period, we've built a great relationship and deep trust with financial planners, accountants, mortgage brokers who are referring the business to us, and we're certainly grateful for that.
Okay, so those accountant-advisor relationships are really important. And what else does it take to maintain a competitive edge in this market?
I think it's, consistency over time. I think that's one of the key things that the market really respects and looks to. And a key driver for that is funding in our environment. So if we observe that over the last decade that we've been playing in this space, back in 2012, the SMSF loan space was actually quite almost called proof of concept phase, where a number of lenders were looking at the space, but there were some question marks around because it was so new, enforceability of mortgages, etc. As this proved out over time, we saw more lenders enter the space, which was excellent for the landscape. But there's certainly been some challenges in relation to funding over that period, whether that's the capital requirements. The banks, for instance, have withdrawn from that particular space because of the complexity and the manual nature associated with that particular product, which is entirely reasonable. For us, however, though, we operate a retail credit fund, which has just over $8 billion invested in that fund via 80,000 investors, of which many are self-managed super fund borrowers. So not only do we understand the space extremely well on the loan side, we're actually funded a lot by these same sorts of entities as well. So it's a space that we're really comfortable with, and we think that's a point of difference between ourselves and others in the marketplace that's allowed us to continue servicing it seamlessly throughout that period.
So as you mentioned, there has been a bit of movement in the market. We've just seen a few changes with interest rates, obviously. What does that mean for SMSF investors? Does that mean it's perhaps a good time to start looking at different kinds of loan offers, particularly if they're in one of those older legacy type products?
Sure. I think, the current environment certainly lends itself to all borrowers looking at their interest rates and doing what they think is appropriate for them. But what we would caution is for borrowers not just to focus solely on price, particularly in the SMSF loan space, because it is quite complex and there are a few barriers with what you can do with those transactions. For instance, one thing that a lot of borrowers aren't aware of is when you refinance, you can't access the equity that's been built up through those assets in your SMSF. So you're refinancing on a dollar for dollar basis purely for price alone. You can't get the equity out that you've grown over time. So that's the first thing. The second and third things that we would ask borrowers to think about is, what are the lender's rules around annual reviews? For instance, does the property need to be valued every year, and therefore you need to make additional contributions if the valuation changes, particularly in the environment we're looking to at the moment where house prices are softening slightly. So that's something that we would caution borrowers to look into closely, but also whether there's any triggers around liquidity in the fund, minimum requirements, also minimum SMSF fund size before you look to move lenders. There are a couple of barriers there which can get quite tricky quickly if you're not across those. So that would be things we'd call out, but certainly price is an important component as well.
Okay, and what other predictions do you have for the property market over the next 12 months?
Well, it's certainly an interesting environment, and predictions are hard to make with what we're facing into. But our house view has been that we would think property prices would retrace between 10 and 15%. As we sit here today, we're close to 10% already. So the upper bound of that range appears to be reasonable. Something in the order of 15% in most areas might be what we see in the property market. How does that translate for SMSF investors? Well, I think it's interpreted as value coming back to the market, where people have been watching the property market with interest and thinking how are they going to get in there and when's the right time. Well, with the house prices coming back, investors will see that that's an opportunity. Also compounded by the fact that as we sit here today, there's record low levels of vacancy rates. In some capital cities, it's less than 1% currently, and that's driving double-digit growth in rental returns annually at the moment. So as an SMS investor, you see property prices coming back, you see very, very strong rental returns and unlikely to change. Building approvals are slowing down, so we're not building enough supply to meet the system demand. Throw in migration potentially over time coming back as well. We think that'll put a floor under house prices and also support those rental returns. So whilst rates are going up, it's being matched by increasing rents at the moment, which is an attractive proposition for SMSF investors.
And finally, what are your future plans for your loan products, particularly those targeting the SMSF market?
Well, it's a funny one because we have no short-term plans imminent with the product, which in and of itself can sometimes feel odd, but what the market tells us is they really like our product as it is. They like the stability of the product, and they're not looking for us to make any changes. There's been so much change going on in the marketplace at the moment that the market is telling us just keep it steady if you can. Having said that, of course, we're always innovating. We've got one or two small things that we think we can introduce towards the end of next year. It's too early for me to forecast what they are yet, but we think they're really complementary to the product. The one thing I can say is that we'll remain committed to the product in this space for many years ahead yet.
Thank you so much for joining us today, Corey. Some really valuable insights there. And thank you everyone for watching.
Thank you.